Good morning. Welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is Tuesday, November 3rd, 2009. It's Election Day here in New Jersey. If you need to reach us during the broadcast, you can phone in toll-free at 1-866-67-CATEX. Overseas, our AOL Instant Mail address is CATEX-TV. It's 11:30 a.m. Eastern Standard Time in the U.S. It's 4:30 p.m. in London. We've got a bit of a breaking story that you probably are aware of. Warren Buffett has made a $34 billion bet on the future of the American economy. He agreed today to buy Burlington Northern Santa Fe Corporation, which is mainly a railroad line. The CEO of Burlington Northern said that Berkshire's $34 billion investment in our company is a huge bet on the railroad industry and on the American economy. Buffett said, most important, it's an all-out wager on the economic future of the United States. I love these bets. Berkshire Hathaway already owned 22% of the railroad, and it said it will pay $100 a share in cash and stock for the rest of the company, which is about a 32% premium over Burlington Northern's closing stock price yesterday. This will be the biggest acquisition in the history of Berkshire Hathaway. So this is pretty big news, actually. The stock market is down about 60 points, even though American manufacturing rose for the 5th time in the past 6 months. Apparently there's some delays on some thoughts regarding the bank's profitability. That's holding everything back. There are no delays on Swiss Re's profitability. They posted net income of 326 million U.S., or about 334 million Swiss francs for the third quarter, compared with a loss of 304 million francs in the same period last year. P&C operating income was just under a billion francs, up from 685 million francs last year. The combined ratio improved from 99.5% down to 84.5%. In asset management, they had shifted to lower risk and shorter duration assets. It caused a decline in the return on investment down to 1.6% from 2.8%. And finally, during the quarter, Swiss Re further reduced its financial guarantee re-exposure by dropping off 6.6 billion francs of notional exposure by commutation. Swiss Re's FG Re's notional exposure has now been reduced by 68% since the beginning of the year. This holds in line with what Stefan Lipp, the new CEO of Swiss Re, set out to do when he came in, getting back to basics. Lipp said that the market fundamentals pointed toward higher prices in the January renewals, but he did concede that, quote, restored industry capital and the absence of hurricanes may partially delay the market correction. Investors are speculating about when the world's second biggest reinsurer, Swiss Re, will pay back billionaire Warren Buffett, who pumped about 3 billion francs, or $2.9 billion, into the company at the height of the global financial crisis. Swiss Re's chief financial officer, George Quinn, said this morning that the reinsurer was unlikely to make an early repayment of Buffett's 3-year loan. That would carry a hefty 12% coupon, because the loan itself carries a 12% coupon. If they make an early payment, it's a steep penalty involved. According to Quinn, that would involve a premium of 40% today versus a 20% premium if we wait another 18 months. It doesn't make sense at this stage to pay it back early, he said, but it's a topic we do review regularly. More news on profits. Flagstone Re in Bermuda, their reinsurance business, has experienced a dramatic improvement in underwriting in the third quarter of 2009. As rate increases, the incorporation of new subsidiaries, and of course the absence of major cats, have driven profitability. The reinsurance segment, which accounts for the majority of Flagstone's premium income, produced a combined ratio of 73.5%. That's an improvement of 55 percentage points compared with the same period last year. Last year's third quarter, acknowledged by Chairman Mark Byrne as Flagstone's only disappointing quarter so far, had included losses of about $130 million for Hurricane Ike and $13 million for Gustav. This year's third quarter also included the contribution of subsidiaries Flagstone Africa and Flagstone Alliance, which jointly added $38 million to the firm's gross written reinsurance premium. The improved reinsurance performance helped drive a third quarter net profit for the company as a whole of $67 million, compared with a loss of $186 million during the same period last year. One company that did not come off so well was AXIS, because of a derivative contract and higher realized investment losses kept the company in the red for the third quarter. The Bermudan insurer and reinsurer posted a net loss of $96 million for the 3 months until September 30th, although this was significantly better than the $249 million loss in the same period last year. The group, however, did make an operating profit for the quarter of $152 million. It lost $161 million in the same period last year. The combined ratio improved dramatically by about 55 points, went down all the way to 73.2%, mainly due to a benign catastrophe quarter and favorable prior year reserve development, which aided the combined ratio by 17 points. AXIS said the current quarter's underwriting result also included an increase of $136 million in the fair value liability of a longevity-exposed insurance derivative contract. As far as we can tell, and there was only a blurb about it in the Bermuda Gazette, it was a life insurance ILS, and they reconfigured the mortality rates. Reinsurance for AXIS swung to underwriting income of $125 million for the quarter. In the same quarter last year, it lost $164 million. So all in all, with that one exception, John Charman's group did pretty well. On some catastrophe news, engineers have finally extinguished a fire on a leaking oil rig in the Timor Sea between Australia and Indonesia. Here's a picture of the rig with the fire extinguished. The rig's operator is PTTEP, a Thai company, said in a statement this morning that the inferno has been put out. And also, the oil well leak, 2.5 kilometers below the seabed, has been plugged. The blaze had been burning for 2 days. PTTEP had feared that the collapse of the rig could worsen the impact of that leak. As of right now, they're saying that the rig looks fairly intact. Insurance Day is indicating that Munich Re's Watkins Syndicate may be on the hook here. They're facing possibly a significant claim resulting from the oil leak and fire on the rig. According to market sources, the claim will certainly enter the London market, although the size of the total claim remains unknown. Remember, since August 21st, about 400 barrels of oil a day have been being pumped into the ocean as a result of that leak. The Thai company, which owns the rig, had contracted the West Atlas Mobile Offshore Drilling Unit from the Norwegian oil rig firm Seadrill to work on its wells. The huge oil spill has now reached Indonesia. It's impacted approximately 7,000 fishermen. Environmental groups are saying that the slick now covers up to 25,000 square miles and is threatening dolphins and sea turtles. PTTEP is believed to have a $75 million insurance policy to cover the repair and cleanup cost of the incident, and according to Insurance Day, the Munich Re owned and backed Watkins Group will face a significant proportion of any claims, as it is the lead insurer on PTTEPA's book of cover. The cover is split between the insurer's offices in London and Singapore. Aon and JLT are believed to have jointly brokered the contract. No one from Watkins, Aon, or JLT was available for comment to the Insurance Day. Stock market still down about 58 points. We'll go to a word from our sponsors.